Good morning, everybody. Thank you for joining Mark Lauder and myself at this webinar, our second BDO's Eyes on Tax webinar for 2023. It's a bit unusual for us to do two webinars this early in the year, but our last webinar we had to pivot and cover a lot of information in relation to the change in the trustee tax rate. And so we wanted to have another follow-up webinar that covered the topics that we promised to cover in the last webinar. So we're going to cover that off today. The recent GST changes. I'm going to talk a little bit about tax and ESG and explore sort of growing trends in tax policy in that respect. Mark's then going to go through some foreign income and disclosure rules and foreign trusts that we've going through. And then, given that this is a pre-election tax special, we're going to share what we know to date on the different tax policies announced by each party, and then to give some context to what you should be thinking about doing either before the election or before the end of the tax year, given what we know. And at that point, I think we'll revisit and recap on that change in the trustee tax rate at 39%. The usual things apply here, guys. Those who are interested in getting CPD hours, this will qualify for as eligible activity for your CPD development. If you want to ask questions, please put them in the chat box up in the top right hand part of your screen. They will be fed through to Mark and I. And sorry, Mark, I should have introduced you, but we'll get to that in a minute. So please put those chat and we'll try and cover those questions off near the end of the presentation. Mark and I are a bit notorious for going right to the wire on the time, but we're determined to try and not do so much talking this time and leave plenty of time for those questions later on, so that we can have a bit more of an interactive session. So thank you for attending. Let's kick off, Mark, and yeah, have a crack at the GST changes.
Well, thanks, Ian. I was already here because I'm feeling quite pleased with myself today because it's given its election, I am wearing my pre-election tax special shirt, which is suitably colourful and doesn't link to any one particular party. So we are politically agnostic in all that we say and all that we wear. Anyway, recent GST changes. So Charlene, if we can move on. So there's four areas that we'll cover off. The first one, I'm definitely a fan of retro. I'm always delighted to see bands like Steps, S Club 7, etc. Human League, which are coming to Selwyn Sounds next year in March 2024, if anyone wants to go. Love the retro. So here's the retro 80s mix tape to introduce our principal purpose test, which is making a comeback in our GST legislation. So those of you who will recall, principal purpose was a very important very important phrase in determining whether or not there was the ability for a GST registered person to claim an input tax. So if your expense met the principal purpose of making taxable supplies, input tax claim available. Now the legislation evolved, and now we have to the extent the expense incurred in making taxable supplies. So principal purpose took a back step. Principal purpose making a comeback in two areas, both of them concessionary, both of them really well received and really good. And I will go through principal purpose part one now. So I'll just do a quick example. So we've got Laura. Laura's a data security consultant, and her hobby is online gaming. And I think online gaming would still include Fortnite, because I do regularly hear my son swearing at the screen nightly to Fortnite. She wants to purchase a new laptop for her consulting practice. So that's the primary purpose, laptop for consulting. But she's going to use it for online gaming, probably about 25% of the time, give or take. Anyway, that's what she tells us. The cost of the laptop is an eye-watering $9,000. So Laura's using the laptop for taxable and non-taxable purposes from a GST perspective. In the absence of a principal purpose test, the comeback test, Laura would be able to claim a GST input tax to the extent she's making taxable speed to 75%. Then she'd have to adjust each year for any changes to that percentage. This is complicated, higher compliance costs. Inland Revenues acknowledge this, and we've moved to this concessionary treatment, which says if your principal purpose is for making taxable supplies, then for goods and services acquired for less than $10,000 GST exclusive, you can claim all of the input and you don't need to make any adjustments. So that $10,000 test is very useful. Alternatively, you can stick with the normal general apportionment that we've got running through the Act, but if you do that, you're stuck with it for 24 months. So it's 2 years before you'd be able to drop into this particular principal purpose test. Principal purpose test part 2, I think a lot of people will be really relieved with this one and very happy. So again, I'll use an example. Scott acquires a holiday home on an island, but it has a secondary use. So the house is for him and his family to use throughout the year, but it has a second. So for 3 months of the year, he makes it available as guest accommodation, so more Airbnb. It's not cheap, and he gets $80,000 turnover for it. So he registers for GST. A few years later, Scott looks to sell the property. He paid $500 for it. It's now worth $1.5 million. He either sells it or he determines not to use it for Airbnb anymore. So he's either going to have to deregister for GST or he's got a sale. Either which way, there's an output liability on the property because it was applied to the taxable purpose. This new principal purpose test really helps those scenarios. So as long as the principal purpose was for the making of other than taxable supplies, and it was used mainly for making other than taxable supplies, and you didn't claim any input tax on the property, and it wasn't zero rated, then you can elect for that property to be outside of the GST net. And the election is merely done just by filing a T return. So this is a really, really useful and excellent change for those persons who inadvertently stumble into GST registration because they might have this Airbnb activity that tips over the threshold required to register, and then you're in this, hang on a minute, I'm a bit stuck now because if I sell the property, I've got a GST output tax liability. This provision here, this principal purpose test, other than making taxable supplies, other than use, etc., really, really helps. So think again of the dwelling with the home office. So you might have a home office that you use for running your taxable activity, you claim utilities, you claim rates, you claim insurance. As long as you don't claim on the bricks and mortar, you can keep that outside of the tax net as well. So that principal purpose test is really useful. There is a transitional rule. So for goods acquired before the 1st of April 2023, there's almost an amnesty period between the 1st of April 23 and 1st of April 25 to pay back any input tax or adjust any zero rating for any property that you wish to keep. You can drop into these rules. So just remember, all's not lost. If you claimed previously, you've got that amnesty period, 1st of April 23, 1st of April 25, 2 years. So that's our principal purpose making a comeback. Electronic marketplace rules. This was all about leveling the playing field, think Uber Eats, think Airbnb, think DoorDash, etc. All those services which the consumer will go to an electronic marketplace, the website, and then somebody else, maybe Ian, during the night. Ian's an Uber driver, and he fulfills the service offering. Thank you, Ian. You've helped my daughter out many times. This is planned to come into force on the 1st of April 2024. What these new rules are doing is they're saying we're going to force the electronic marketplace to deal with the GST on behalf of the service provider, the Uber driver, the DoorDash person. So there's an implicit assumption that all those persons would, should, could be GST registered. So the market will charge GST output tax at 15%. If the Uber driver isn't a GST registered person, then they are entitled to a flat 8.5% input tax credit for underlying assumptions around what costs they may incur and to make it a bit more equitable. If the Uber driver is a GST registered person, then merely what happens is Uber deals with the GST output tax at 15%. The supplies by the driver to Uber are zero rated, and then the Uber driver will claim their inputs in the ordinary way. This does beg the question, Ian and I were talking about this yesterday, will this end up with some persons who otherwise wouldn't be over the threshold to register for GST because the input tax claims that they would be afforded would be higher than that notional 8.5%. So obviously, from a logical perspective, if your expenses are higher, you've got more inputs than the 8.5%. The way to unlock them would be to register for GST. I think how far does it go? And I haven't dipped into the legislation enough to work this out, and neither do we have enough precedent or understanding of how it is expected to work from 1st of April 24. But does it go wider than just your obvious ones, your Uber, your DoorDashes, your Airbnb, and extend to maybe some of those more domestic players within our marketplace that offer those types of services, certainly in the Airbnb space? So that's our electronic marketplace rules. Directors' fees. It's not a change, it's more of a reminder, and I suspect it's more of a reminder from Inland Revenue because we're not always getting it right, and it's time to remind. So we start off, GST registration. We need a taxable activity. Taxable activity is defined, something that's continuous or regular for consideration, but it excludes certain activities. One of those activities is the activity of being a director of a company or on a board of companies. So if you are a director of a company, you should not or cannot register for GST in respect of that activity unless it's associated to your ordinary taxable activity. So again, I might as well pick on Ian because he's the only person I can see. So if Ian, in his capacity as a partner of BDO, also operates as a director of companies, then that effectively links to his activity of being a tax advisor, and the director's fees would be subject to GST, and he can claim his normal inputs. It does get really, really murky and a bit confusing. Inland Revenue, this morning I received an email just with another questions we've been asked. One of those questions is around personal services companies. So if Ian were to operate a personal services company, which then provided directorial services to others, then the question is, should the personal services company be registered or entitled to register for GST? In this case, Inland Revenue has confirmed their position that the personal services company can register for GST, i.e. its activity isn't excluded, provided it meets all the other criteria, because the company is not providing directorial services, it's something else, and they run through the whole factual positions, etc. But just please be careful, retired lawyers, accountants, etc., that are still carrying on roles as directors. Just have a think about your GST position and whether or not you've got this one right. Change of use timing. Again, concessionary, it's a lot friendlier. It's a real headache. It's a compliance cost that can go on forever and ever and ever. So, but not now. So if we use an example again, you've bought something that you're going to use 80% of the time to make taxable supplies. You claim 80% of the input. Each year, you have to assess whether or not you're still at that 80%. So you work out what's your actual use, and then you make an adjustment, higher or lower, and within the thresholds, to account for maybe claiming a bit more GST input tax, or you have an output tax liability to correct the overclaimed input tax because you're not at 80%, you're actually at 60% taxable use. We are really pleased to accept fewer adjustment periods. So, for example, if it was you'd be adjusting for land on an indefinite period of time. The rules now are that the new adjustment periods are if you're under $10,000 cost, no adjustment periods required. If the cost is between 10,001 to 20,000, 2 adjustment periods, 20,000, and this is an interesting jump to 500,000, 5 adjustment periods, and then anything over $500,000 is 10 and land is 10. This is a lot friendlier. There's less to do because we've got less adjustment periods. Don't forget the wash up on sale. Ian, back to you.
Yes, thanks, Mark. Apologies if people were experiencing a little bit of breakup and delay in some of that presentation. Hopefully the technology will sort of sharpen up through the rest of the presentation, and hopefully you don't experience that same delay with my next comments. Look, ESG, what I want to do here is just quickly explore the concept of ESG and why it's important to the company, but also consider it in the sense of a tax. ESG is really a growing trend. There's no board in the country who should not be considering their ESG policies in that context. And I want to try and explore what's happening in the world, and then can bring it into context of what New Zealand is currently doing and what we can expect out of it. So I don't want to take too much of your time, but what does ESG stand for? It's your environmental policies, your policies within social, and your governance. And there are some examples under each of these headings on the slide. Now it's quite, it's interesting when you look at those bullet points that are under each particular topic, it's not obvious what role tax would have in relation to those certain areas. But in BDO, we have globally considered that. And if we can go to the next slide, where we have sort of framed where those tax policies could kick in. So from an environmental point of view, it might be sort of particular taxes on carbon, on plastic, might be green subsidies and incentives. It might be just having that carbon net zero kind of goal. In a social environment, it's really about having tax policies that facilitate equity, facilitate flexible workplaces and workforce and global mobility. There might be some bias towards ethical investments, and interestingly, paying a fair share of tax, and I'll come to that in a minute. And in the governance sense, it's really around your governance of your behaviour in the ESG space, and in particular in terms of tax reporting, controls and compliance, and managing risks. So what BDO have done is, through Robert O'Hare, our Global Director of Tax Policy, explored a survey of our independent member firms to see what other countries were doing. And I just want to take you through a sample of some of the questions that came out of that. because I think it helps contextualize what we mean by tax in the environmental space and tax in social and governments. So the questions that were asked were things around like, does your country have a net zero target? Has it introduced any new green tax measures during 2022? Has it withdrawn any tax measures during that year? Does it tax carbon? Does it have some policies that penalise or incentivise behaviours of the entity or the employees? And in particular, I guess, following the invasion of Ukraine and the challenge that put on the oil supply and the energy, was there any specific response to that energy crisis? Now, I won't take you through all of the questions or all of the answers, but I wanted to share the next sample with you. So there was quite a large percentage of the countries hadn't introduced any new green tax measures during 2022. Now, that doesn't mean to say that those countries didn't have green tax measures. They may have had some already in place. So there's a limitation on that, that question. But interestingly, some had introduced 1 to 3 new measures and 4 to 6 new measures. And one of those countries, I believe, that had introduced 4 to 6 new measures was the US. And the US, you know, is obviously a big player in the global tax market. New Zealand is not alone in having an ETS, but there are things around carbon tax and fuel duties that we've done that apply in other countries. And how successful is incentivizing certain types of behavior? And there's a number of countries that have had accelerated tax allowances. You know, I think we've got some around the farming area where there may be some incentives for improvements to land, to waterways, and to that type of thing. Is there a reduced duties on green consumption? And a little bit disappointingly, there's not many that have tax credits on green R&D, although, you know, we've got an R&D tax incentive credit system which is agnostic as to whether it's relating to green measures or other scientific or technological uncertainty that's trying to be resolved. We also ran the survey for the social environment, and I'll share the tax questions there that were done. So here was it, and actually some of these questions I could argue would be fit more under the governance label rather than social label. But does your country operate a tax disclosure program? As an amnesty program? Does it register? Does it have or operate a register of beneficial ownership for individuals? Is there exchange of tax information with other countries? And what we found is that there is an absolute growing trend to increased disclosure. Exchanging tax information between countries is absolutely normalized. We've got it under our AEOI, Automatic Exchange of Information program, common CRS, Common Reporting Standards for trusts and various things. And we saw in New Zealand the HNWI project where they were trying to track down who owned what in those larger family groups. So that is happening all over the world. And the other questions were around: do you have again tax measures to penalise socially irresponsible or incentivise socially responsible behaviour, and are you got some proposals around tax transparency? Interestingly, they also asked the question: do you have a formal mechanism for facilitating the making of voluntary tax payments over and above the legal minimum tax due? And of course, this is interesting after the open letter from a number of the high wealth families that said we'd like to pay more tax. So again, we'll move to the some of the social answers there. So in terms of incentivizing socially responsible behaviour and penalising socially irresponsible behaviour, there's quite a range of types of things that happen. It might be tax advantage to charitable donations, tax advantage to ethical investments. It might be a sugar and salt tax. We're well used to tobacco and alcohol tax. That seems ingrained pretty much all over the country. Some gambling taxes and maybe some disadvantages for unethical investment. So I think there is a prevalence for measures in those spaces in many countries. what this survey didn't do was find out whether those were effective, and did it result in a reduction in sugar consumption or salt consumption, etc., and result in obesity. And even last night, driving home, I heard on the radio a specific discussion on this very topic as to whether it was effective or not. Interestingly, mechanism to voluntarily pay more tax than is due, a whopping 87.2% said there was no such mechanism for that to take place. And I think that was quite interesting. And I think some of it's because there might be some other measures like philanthropy or a donations type situation where they're trying to direct the extra money to other pet projects that could be happening. It also could be that they don't there isn't sort of formal mechanism, because it might be inappropriate for the government to seek to collect more than they should collect to fund their programs of expenditure. The interesting thing, I think, was after the Starbucks scandal in the UK, where Starbucks offered to pay a voluntary amount of tax to bring the tax dispute to a close. The UK responded with, well, there's no formal mechanism, but taxpayers can ask Her Majesty's Revenue and Customs, and of course that'll be His Majesty's Revenue and Customs now, if they can undertake voluntary restitution to pay tax that HMRC are not able to collect. So I think it's an interesting question. Moving on to how do we contextualize this in New Zealand? Well, look, if I think about the green situation, we've obviously had the headline policy around the clean car rebate and the supposed ute tax. And as a driver of a fully electric vehicle, I have to confess that the clean car rebate has incentivized me to at least buy one extra electric car than I should have done. But I take great pride when I drive past the petrol stations with my EV electric car. We had a recent introduction of a fringe benefit tax exemption if employers were to provide scooters, bikes and electric bikes to employees. As an occasional cyclist to work, the other part of this is having changing facilities at the on premises to help, because it rains a lot in Auckland, and it certainly rained a lot this year, so that you can cycle into work without and still be able to perform at a reasonable level. Can we do more? Well, I think there's some interesting stuff happening around food wastage. In Auckland, we've just started a collection we offer food scraps, and those food scraps collection is going to be converted into biofuel. I think that's an interesting one. In Australia, they're working on an initiative for the donation of food from say supermarkets or restaurants where there's excess food, and it's going to places of need, such as families that need additional assistance on food within the food crisis, or to food banks, etc. And I think that's been that's quite an interesting, a slightly different focus than ours. Tax and ESG. Look, I think your ESG policies are increasingly important to a business context, and if you're looking to sell your business in the future, or looking to buy a business, there's an important aspect to sort of getting across what your ESG policy and being able to clearly articulate that. And I guess making sure there's no, you're not operating in a country where there's a lot of fines or penalties that could be exposed within that. So ESG is becoming an important part for due diligence. The last thing I would say about New Zealand is, the fact of the matter is transparency is here to stay in the terms of tax world. We're seeing from the survey that there is global moves around increased disclosure, increased tax transparency, and increased exchange of information. So we've got to accept that transparency is here to stay, and that things like the new trust rules, where there's additional disclosure that have been introduced, is just a fact of life. Interestingly, in some of the countries, there has been some disclosure around that becomes publicly available, and that creates a real challenge around privacy of information and data. In New Zealand, that's not the case. It's obviously still private to the context between yourself and the Inland Revenue Department. But it's never been a good idea to have a tax policy that you're trying to do something where on the assumption that the revenue will never find it. You've got to accept that transparency and disclosure will apply, and be prepared to deal with that properly. And that gives me a nice segue to Mark's next comment on some of the foreign trust disclosure information and foreign income.
Thanks, Ian. It does give you a nice segue, but I'm going to go back to ESG because I've just thought of a solution for your rainy weather and e-bikes and e-scooters, and it has a retro theme, so it's if you don't know what, look it up. But we could bring back the Sinclair C5 and have an umbrella holder, much like the Beetle has a flower holder, I think, or a flower cup holder. But the Sinclair C5 electric with an umbrella holder is just the ticket and will solve your rainy day conundrum, Ian. You can thank me later for that one. Anyway, back onto transparency and it being here to stay. We are very much the old game of hide and seek, which I think might be the next slide. I'm not sure, but there is no such thing as hide and seek. It's you can try and hide, but the process will tell us where you are. Now, this new disclosure IR 1261 is just that. Next slide, please. So this is just for individuals, but there is a new disclosure which is current now. It's respect from the 2023 later income years. Individuals need to complete it. It requires disclosure on types. To break it down country by country, it requires you to let them know what the foreign tax credit associated with it is. But the whole deal is to make sure that you are declaring based on information that Inland Revenue has received from other jurisdictions. So we've got our common reporting standard, etc., which is going to give Inland Revenue the relevant information. And they want to make sure that it marries up to what you are telling them in the income tax returns. It's going to be, in some regards, it's going to be quite challenging, quite interesting, given our fifth regime doesn't necessarily tax a dividend. It might tax 5% of the opening market value. It might tax based on the increase in value of that particular overseas investment. That's not necessarily going to equate to the dividend information that Inland Revenue has got from the overseas jurisdiction, therefore harder to marry up. How are we going to deal with really large portfolios through multiple countries and multiple foreign tax credits form or the information from our portfolio manager? We don't know. But those two areas could cause a bit of a headache. Again, it's another level of compliance. There's no two ways about it. IR 1261 needs to be provided for all foreign income types. So that's our individual overseas income disclosure, just for individuals at the moment. If we move on to, I think we've called it foreign trusts, but let me drop back to our exemptions. Now trusts, New Zealand, we are pretty complicated with trusts. We've been given a bit of a bad press in the past because we've been seen to be a trust haven. And that's largely because of our set law based regime, which is different to overseas, which might look at a trustee based regime. So as a general premise, if the set law of a trust is a New Zealand tax resident, then we're going to seek to tax worldwide income. If the set law isn't a New Zealand tax resident person, then we're possibly looking to exclude foreign sourced income. Now, one of those exclusions or exemptions, you have foreign sourced income derived by a trust which has New Zealand trustees, then that foreign sourced income is exempt, providing there is no New Zealand resident settlor of that trust at any time in the income year. So you can get the scenario. So those jandals are actually flip-flops where I come from. So you can get a scenario where you're flip-flopping in and out of an exemption. For example, your settlor is a resident of New Zealand for this income year. Your settlor is not a resident of New Zealand for a subsequent income year, and so on and so forth. Now, when the policy officials were looking at this in the recent Perm Bill, decided that wasn't what the Act intended. So they've included a very small word, as opposed to saying foreign sourced income derived by a trust. It now talks about foreign sourced income derived by a foreign trust. Now, foreign trust by definition largely would be a trust that has never had a New Zealand tax. I appreciate you can have complying foreign trusts, but I don't want to get into that today. So now that we've got this slight change, so only foreign trusts can avail of this exemption, you have to be really careful with what we might have done in the past, i.e. we might have said this year you get the exemption, next year you don't, depending on where the settlor is, if the settlor is fairly transient. We are going to have to be careful for settlors who leave New Zealand and retain New Zealand resident trustees, etc. If you do qualify for the exemption, then the trust must register. Again, it's more transparency, more information, and there is a fee to be paid to register. So it's a fairly hidden change within that Act, but it does have quite can have quite big ramifications. And just be really careful as well. The definition of a settlor, as we know, is really wide, and it has been wide. And I think we talked about it last time. Beneficiaries who are owed more than 25,000 from the trust that don't charge interest are also considered to be a settlor of a trust. So if you don't think you've got a resident settlor in the past, and you might not have done, and are availing of this particular exclusion, you might do going forward, depending on how you've dealt with your beneficiaries, if you have New Zealand tax resident beneficiaries. So those are the two things that I wanted to cover up in.
Thanks, Mark. Couple of things I would just sort of comment. I think the IR 261, I think it pays a little bit to go through that. In particular, I know I've been a big fan for our clients who've got portfolios of foreign equities, that when they are managed by local New Zealand fund managers, we get a really compliant tax report, which helps us complete their tax return much more easily in terms of the FIF information, the FDR, etc. And hopefully in those situations, there'll be some reporting that can come that can help us fill in those IR 261s when they're managed from onshore, when the person has their fund manager offshore, and for whatever reasons, quite often for new migrants who've come to the country, they've got an advisor in their home country, then it becomes a bit more of a mission. So that would be something. And I think in the trust, the foreign trust one, I think you touched on it, Mark, around the settlers moving in and around and outside the country. You know, we've got a much more mobile workforce and a much more desire to go global, and that there's going to be lots of issues arising out of tracking where those people have gone to in respect to those trusts. Anyway, let's get to the fun part. Who's going to win the election? No, that's not what we're going to talk about. We're going to talk about the tax policies that each of the countries have, each of the parties have announced to date. When we sent this invitation out, we recognised that we might not have all of the information because it's still a little bit early prior to the election on 14th of October, but we thought it would be a good excuse to at least share in a non-political way each of the policies and then surmise around what you should or should be thinking about doing beforehand. Mark raised his shirt. I'm just kind of, my webinar waistcoat is salmon pink with a few different colours. Hopefully I'm neutral enough in that respect. to not be seen as political. Apologies about the blue shirt, but it goes nicely with the salmon pink waistcoat. Now, I can't remember in the sort of 35 years that I've been here, as much headline news grabbing around tax policy than there has been in this prior to this election, or in this over the last month. There's been significant, and it's probably been sparked by the Greens announcement on introducing a wealth tax and a capital gains tax in their plan, in their terms of their policy. But it has been a topic that has grabbed the headlines of the newspapers, and I guess, good God help us, talkback radio. And so I think it was appropriate to have a look at that tax policy. So let's just summarise what we know to date. So taking Labour and national policies, this is what we've found to date. Look, Labour haven't announced their formal tax policy, and that's probably not unusual in terms of the incumbent government often keep their powder dry to quite close to or closer to the election. Obviously, there's a much publicised announcement by Chris Hipkins that while he's Prime Minister, he's going to rule out the introduction of a capital gains tax and a wealth tax. And that has already caused the resignation of David Parker as Minister of Revenue, who had clearly been working behind the scenes with the following the HNWI survey to work on a capital gains tax or particularly a wealth tax. I think in particular he said the wealth tax. So that's been ruled out at the moment, but we don't know much else about any changes in Labour's policy in terms of tax. Look, National have made quite, again, I don't think their tax policy is out in detail. They made some announcements back last year in sort of March 2022 that they were going to change the brackets, the tax brackets for inflation. And I think they've pivoted a little bit from saying I'm going to get rid of the 39% tax rate to actually, we might keep it for now, but we might get there. We might still look to introduce tax cuts later on. These were the brackets that I found from the press release in March 2022. Subsequent press releases or on their website just focuses on the savings within different brackets. I haven't done the maths to see if that would be the same bracket there. I guess interestingly, they've said what they're going to do is going to unwind some of the Labour's recent tax policies, and in particular the 10-year bright line extension for residential rental properties, the non-deductibility of interest on rental properties, income insurance scheme, regional fuel tax, various other things, etc. I think they've been silent on the trustee tax rate change to 39%. I haven't seen anything from them where they've turned around and said they're going to reverse that. So we could speculate on whether that what might happen there, and watch this space, I guess, over the next 8 weeks. Next slide, please. The Greens, well, they've also announced a change in tax rates and a slightly different explanation to the to National, but those tax rates are in there. So they're talking about the 39% tax rate kicking in at 125,000 rather than 180,000, but still keeping and importantly having a 0 to 10,000 tax-free savings, a 0% tax rate at that stage. And I guess that's quite a significant change. And there are many countries where they have a sort of tax-free threshold to start with, but it's not one that we've had in New Zealand for many times. Although, arguably, with working for families tax credits, a lot of that tax would be rebated back. They made an announcement on wealth tax, 2.5% on net assets above 2 million for an individual and 4 million for a couple. And that's net after taking account for mortgages and debt. The wealth tax on trusts is going to be at 1.5% because we've got to stop people hiding assets in their trusts and hiding wealth in the trust. I guess the difference between a 1.5% and 2.5%, I haven't dug into any of the detail here, but I can surmise that the challenge with a trust is it's held for multiple beneficiaries. not for just one individual or one couple, even though the couple might be the principal beneficiaries of that trust. So perhaps that's why the 1.5% rate is different for individuals and couples. One might see it as an incentive to put those assets into the trusts, curiously. But I think our trusts seem to be getting a bad name at the moment, but I'll come to that later on. Interestingly, company tax rate to go to 33%, which is a rate we haven't had for many, many, many years, and would set us above many of the company tax rates in places like Australia, and a guaranteed income of $385 per week. Act has introduced a change in tax rates, slightly simpler, just two brackets, 17.5% and 28%. They've also said they'll abolish the bright line, but they've said abolish it. So I'm wondering if it means they'll abolish the 2-year rule, the 5-year rule, the 10-year rule, and just tax it profits on land speculation by applying the land transaction rules that we've got to date. Don't know. We'll see what happens there. Reverse interest, non-deductibility, and the income insurance scheme. And they've announced a carbon tax refund, which again, I think it's sort of really trying to earmark that revenue generated out of the ETS scheme is earmarked for climate policies. Lastly, but not least, I've included the Opportunities Party and NZ First. The Opportunities Party included an announcement on brackets, and their brackets go up to 250,000 at 45%, so quite a high tax. A land value tax on urban residential of 0.75%, and then some provisions around universal savings to try and help young kids get into get a savings boost and try and create a culture of saving, even if that's earmarked for education, training, or KiwiSaver. They had a phase 2, which is trying to get a universal basic income in for 18 to 65-year-olds, a single income tax rate for personal, company, and trust, and that's that alignment of all of those rates, and increased land value tax eventually from 0.75% to 1.25%. NZ First, they've only just met their AGM. I didn't see any formal policies coming out from there, but they did see an announcement that we'd adjust the tax brackets for inflation so that we'd adjust that bracket creep. So what does this mean? I think the context here is really...
Iain.
Yeah,
Iain,
sorry, Mark.
Sorry, mate. Sorry, just very quickly, because I've got to do it because I've done it now. But when I was looking through this, I suddenly remembered another party that you've missed for good reason, the Monster Raving Loony Party, which I remembered back in the maybe 80s or 90s, so it's retro again. They don't have a tax policy, but I thought I'd share just two of their policies in case they're of use. The first one is they're going to reduce inflation by giving everyone pins, which I thought was quite good, and to prevent identity theft. Raving Loony Party, and I'll put back to you, Iain.
Yeah, well, when I arrived, there was no Monster Raving Loony Party, but there was the McGillicuddy Serious Party, which I actually got my first vote in the general election because I thought it sounded Scottish and it was based out of Dunedin, but I was a new Scottish migrant, so there we go. Look, the big question I'm always asked is, like, what should we do? And the challenge is we don't know what's going to come in. Look, you could take a gamble. Is National going to win the election with ACT and have all those policies reversed? Is there going to be a Greens Labour, and will that bring capital gains tax or wealth tax back onto the shelf? Given National's silence on trustee rate, I think we've got a situation around what we do know is that trustee tax rate at 39% is going to 1 April 2024. And in the last webinar, we talked about not having a lazy trust. And what I mean by lazy trust is where we just paid the tax at 33% on the trustee rate and we didn't allocate out beneficiary income to beneficiaries who might be on a lower rate. So we wanted to be more active on that trust situation. I raised the question whether you can invest in the pie. Like, as a trustee, you've got an obligation to make fiduciary investments, get the best return for the risk reward for the trust. And that's a fairly serious obligation. Pies, portfolio investment entities, are taxed at 28%. So as a trustee, is it appropriate for you to run your own portfolio outside of a pie and get taxed at 39%? Or should you be taxed at, or should you invest in pies? And will this, force trustees to invest in pies through that sort of, through that mechanism? So, of course, that depends on the return coming out of the fund. It depends on the beneficiaries of the trust and what their marginal tax rate is, and all of those sort of factors. So there's no hard and fast rule, but trustees should be careful around documenting their investment plans and why they make those investment decisions, and bearing in mind that that difference between 39% and 28% final tax in pies is a significant difference, and your return would need to be significantly higher to cover that. I also discussed in the last the use of a holding company, and this is a holding company where you've got a trading business that's generating your wealth. You wanted to traditionally pay the dividend up to the trust, because a trust is a good vehicle for owning capital appreciating assets, and the dividend could then be used to go and make other investments, etc. With a holding company interspersed between the trust and the trading company, you've got the opportunity for a dividend trap to take place at the holding company. And that's only effective if you're going to use the funds created from the dividends in the holding company to make business investments in taxable entities, tax-paying assets, not into things that are, your boat, your batch, your BMW types things. So if you're taking money out from the company to fund your personal lifestyle, you should pay tax on that money. If you're bringing it into the if you're going to make an investment and you want to get it away from unsecured creditors, then a holding company is something you should look at. If you're introducing a holding company, you need to do it in a smart way, and you need to do it carefully, because there are things like anti-dividend strip rules that could be applied if that trading company is already pregnant with imputation credits, and so you've got to take care. But I think you should be looking to do that before 31 March 2024, and probably look at doing it now rather than later. So we'll come to that. Look, the wealth tax, does it come in? What do we do? What can we do? What can you plan around that wealth tax? If it comes in, do you spend it? Do you give it to the kids? Do you spread it around the different members? All of that will depend on what the detail is. The proposal was you could defer paying it until death, so you're not going to get paid until your final estate comes out. But then that's effectively a death tax or inheritance tax, if you like. If a capital gains tax come in, the one thing is it's always standard. You're going to get a market value on the start date. So in some ways, there's no need to panic if they bring a capital gains tax. There is a huge number of capital gains that are taxed as ordinary income in our Income Tax Act. And what we've got now is a real hodgepodge of rules in relation to that. And the residential rental bright line at 10 years is a classic one in relation to that. So in some ways, I would like to see a capital gains tax come in properly designed, properly formalised, to remove some of this hodgepodge and have it well designed and well catered for. And if you get that starting point, and definitely a capital gains tax that's only on realised rather than unrealised capital gains, because nobody wants to pay tax on some income that you might not otherwise earn. Finally, just to sort of circle back on our policy, ESG is here to stay. The transparency and the extra disclosures is here to stay, and therefore I think you should be working as a company and an organisation to try and put forward some focusing tax as part of that ESG dialogue. Oh, there we go. Any questions then, Mark? Have we got any through?
Yeah, we've got. I'll cover one off quickly, which I think is quite good, because there must be someone out there thinking crypto. So the first question is, how do we lodge a loss in crypto investments? So look, this is an opportunity for me to draw your attention to a webinar that Iain and I did possibly, I don't know, 3 or 4 webinars ago, where we covered what trading you've bought for the purpose of resale, profit making undertaking or scheme. There's quite a lot in that regarding crypto. Lots of Inland Revenue publications on crypto. So look, have a look at that webinar. The other question is, what's your proposed solution for disclosing FIF income in the IR 1261 from multiple jurisdictions when the portfolio report provides just one figure and doesn't split the FDR calculation by jurisdiction? That's a really good question. We know that Inland Revenue are grappling with it, and we know that Inland Revenue is receiving these issues loud and clear and are looking through them. We haven't had anything back yet. Like a lot of compliance, there is a best foot forward approach. If you do only have one figure and you cannot extrapolate it out, then it would be wise to let Inland Revenue know that this is what you have done, on the basis you can't do anything else. I think, unfortunately, for the the managers out there, and they did it with FDR and with CV, etc., and provided very detailed reports. Some of this issue will be resolved by those providers in providing the taxpayer with what they need to fill out the IR 1261, which then may push back on fees, etc., or have increased fees. But at the moment, in terms of a proposed solution, that we've got time until, if you've got an agent to file your longer, if you have an agent to file your tax returns. We are still waiting for guidance, but in the absence of anything else, honesty and transparency. This is all I've got. This is what you'll get, and take it from there. Iain, have you got any other views on that?
No, I think it's it's obviously an industry issue for those fund managers domestically, and it's going to be harder for those clients who've got portfolios managed from offshore. It's an indication of the wanting to collect the right data so that they can make the exchange of information between the different jurisdictions more appropriate and easier to track. So I think it's important. I'm not sure, Mark, if there's any penalties for filing an incorrect disclosure, or it's probably on one of those disclosure penalties. So it'll be interesting to see what sort of whether the Inland Revenue take a hard line on that to begin with.
I think if you're not willingly or trying to create a hidden disclosure or something, then I'd have thought that there should be some leniency there. So best attempt, but just be careful, as Iain said, because we don't want to fall foul of not having the statutory time bar because we gave them nothing. Best to give something and then highlight, because if you omit a source of income, then of course the statutory time bar can apply differently. The only other thing that's come through, Iain, and I think it's worthwhile, just in case we got the slides slightly incorrect, just an update. Green Party website, just checked it as well. 45% for income over 180,000. Apologies if the slide says something different. There might be some time lag between preparing and what's come out in the wash. But look, I think it's 9:59.
We'll update the slide.
Yeah, back to you, Iain.
Yeah, we'll update the slide for that. Yeah, look, I think that one of the questions when the trustee tax rate came up at 39%, which we had when we had a post-budget director's breakfast, was whether we ever saw the company tax and personal tax rate being aligned. You know, the good old days of 33 was something that was kind of worked quite seamlessly, and we didn't have dividends, retained earnings been building up in companies because they didn't want to pay the 5% withholding tax, and now it's going to be an 11% extra tax for those taxpayers than 39%. So I don't know if I don't see that being aligned at 39. When I once asked David Partington, who was a head of policy at Inland Revenue, a very senior officer at one of our tax conferences, he did say 36. He could see that in the future, but he's not setting that agenda. That's set by the political parties. Anyway, it is the end of our webinar. Thank you for everybody for participating in this session. Hopefully you've got something to take away. from the session. If you have any questions that come out of it, like some more information, please contact your local BDO advisor, and the information will be published on our website, as will there be a recording of this session. So thank you for all your attendance. We really appreciate your support, and hopefully you get through this winter weather, and we look forward to a nice summer ahead.
Go the football Ferns.
Go the football Ferns, yeah. No more VARs.
Yeah. Bye, guys.